Welcome, everyone. Let's get straight into it. Today, we are systematically breaking down capital gains tax reliefs. Consider this your definitive masterclass, your ultimate explainer, for safely navigating the Finance Act 2024 ahead of those upcoming 2025 exams. We're going to take our time here. We'll go step by step, making sure you truly grasp the mechanics behind every single rule.
Here's our roadmap for the session. First, an overview of CGT reliefs. Second, rate reducers, specifically BADR and IER. Third, deferring gains through rollover and gift reliefs. Fourth, we'll tackle share exchanges and takeovers. And finally, number 5, the substantial shareholding exemption. Let's jump right in.
So, Section 1, Overview of CGT Reliefs. Let's take a high-level look at our 4 main reliefs to understand how they fundamentally alter a taxpayer's burden before we get bogged down in the complex calculations.
Okay, it is absolutely crucial to draw a hard line in your mind right from the start. We have 2 primary mechanisms. On one side, we've got the rate reducers. That's Business Asset Disposal Relief, commonly known as BADR, and Investors Relief. These are fantastic because they permanently drop your tax rate to a flat 10%. On the other side, we have the gain defers, like rollover and gift relief. Now, these don't reduce your final tax rate at all. They literally just kick the can down the road, pushing the inevitable tax bill into the future. Getting this fundamental divide straight is your very first step to mastering tax planning.
Moving on to Section 2, Rate Reducers, BADR and IR. Let's zoom in on our first major category of relief, starting with the heavily tested Business Asset Disposal Relief.
All right, I need you to lock this massive number into your memory right now. £1 million. This is the absolute lifetime limit of gains that an individual can shield at that sweet 10% flat rate under BADR. Just to put that into perspective, if a higher rate taxpayer maxes this out, they're saving 10 pence on every single pound. That's a maximum lifetime tax saving of £100,000. Not too shabby, right?
So, how do you actually get your hands on this massive relief? Well, if you are disposing of shares in a personal trading company, take careful note of this exam checklist. You must satisfy all 3 of these conditions. First, hold at least 5% of ordinary shares. Second, hold at least 5% of the voting rights. And third, be an officer or an employee of the company. But here is the real kicker. You have to hold all 3 of these simultaneously for the exact same continuous 2-year period ending on the date of disposal. Seriously. If you miss just one condition for a single day, no way. BADR is completely off the table.
Okay, now let's layer in some nuances, because the examiners love their exceptions. You've got to remember that enterprise management incentives, or EMI options, are a massive exception here. With EMI, that 2-year clock starts ticking the very second the option is granted, not when you actually exercise it. And even better, that strict 5% shareholding rule is totally waived. You also need to watch your back when it comes to goodwill. You absolutely cannot claim BADR on goodwill that's transferred to a close company if you retain at least 5% of the shares afterward. Why? Well, it stops people from artificially incorporating just to snatch up that 10% rate.
Now, here is a classic trap for students, the associated disposal. Think of it like this. You own an asset personally, maybe a building, but it is being actively used by your company for its trade. If you sell that building at the exact same time you sell your business, it can actually qualify for BADR. But listen very carefully. If you've been charging the company rent to use that personal asset, you have to proportionately restrict your BADR. Basically, the tax man says you can't have your cake and eat it too. You don't get to enjoy rental income and full tax relief on the disposal. Now, I want you to contrast BADR with our other rate reducer, Investors Relief. Look at that number. Investors Relief boasts a staggering £10 million lifetime limit. That is literally 10 times larger than the allowance for BADR.
And this comparison brilliantly highlights the conceptual divide between the 2. BADR is designed purely for the internal operators, the officers and employees who are in the trenches running the business, for at least 2 years. Investors Relief, on the other hand, is strictly for the outsiders. To unlock that massive £10 million limit, you absolutely cannot be an employee or officer, and you have to hold newly issued shares for a minimum of 3 years from April 6, 2016.
Right, let's move on to Section 3, Deferring Gains, Rollover, and Gift. Having mastered the rate reducers, we are deliberately pivoting to our deferrals, where we take today's gain and essentially roll it into tomorrow's asset.
So, the golden rule of rollover relief is incredibly strict, so make sure you write this down. Both the old asset you're selling and and the new replacement asset you're buying absolutely must be qualifying business assets actively used in the trade. Simple investments just do not count. The mechanics? When you sell the old asset, you defer the gain by deducting it from the base cost of your new asset. But pay really close attention to partial reinvestment here. If you happen to pull out any uninvested cash during the switch, boom, that cash is immediately taxable as a chargeable gain.
You also need to strictly memorize this reinvestment window. For rollover relief to apply, the new replacement asset has to be acquired within a very specific time frame, anywhere from exactly 1 year before the date of disposal all the way up to 3 years after the disposal date. Don't let those dates slip your mind. Now, what happens if your new asset is a depreciating one? Say, plant machinery with an expected life of less than 60 years. Well, that completely changes the game. You do not adjust the base cost here. It wouldn't make any sense, right? Because the asset is going to drop to zero value eventually anyway. So instead, the gain is held over. It just sits there on the sidelines, waiting. And it crystallizes, meaning it suddenly becomes taxable at the earliest of 3 specific events. Either when you finally dispose of that new asset, when you stop using it in the trade, or exactly 10 years from the day you bought it. Whichever happens first.
Okay, let's unpack our second deferral mechanism, gift relief. Let's break down the math nicely and slowly. When you gift a qualifying business asset, you don't pay any tax on that day. Here is how it works. Step 1. The recipient takes the open market value at the exact time of the gift. Step 2. They simply subtract the deferred gain. And Step 3. That resulting number simply becomes their new lowered base cost. So they'll eventually pay the tax when they decide to sell it down the line.
I want you to literally pause here and circle this in your notes because it is a massive exam trap. If a taxpayer uses gift relief when transferring an asset into a new company upon incorporation, it artificially depresses the base cost of their new shares. And since tax law absolutely hates double relief, doing this effectively blocks the taxpayer from claiming BADR on those specific shares later on. You always have to check if claiming a relief today is going to destroy another relief tomorrow.
Section 4. Share exchanges and takeovers. Let's elevate our focus now to Section 135 relief, which deals with some of the trickiest corporate mechanisms, share-for-share exchanges and takeovers. Take a breath here, because this requires some real focus. When you're looking at a corporate takeover that involves mixed consideration, you have to carefully apportion the original base cost of your shares. As you can see, for any new shares you receive, there is no immediate gain. It's totally deferred until you eventually sell them. However, for any cash you receive, assuming it breaches that tiny £3,000 or 5% threshold, you're getting hit with an immediate chargeable gain right then and there. But here is the critical part. With qualifying corporate bonds, or QCBs, the gain is calculated today but deferred until you sell the bond. And the vital catch? Those deferred gains on QCBs will never, ever qualify for BADR when they finally crystallize.
So, why does this matter? Well, think about it. The new acquiring company might be some massive PLC where your client holds way less than that required 5%. If that happens, they instantly lose their BADR status going forward. Because of that, smart tax planning dictates you might actually want to formally elect to disapply Section 135 relief altogether. Yes, you willingly choose to pay the tax today, but you do it to lock in that sweet 10% BADR rate before you lose your eligibility on those brand new shares. It's all about playing the long game.
And finally, Section 5, Substantial Shareholding Exemption. For our last technical topic today, we're moving away from individuals completely and looking at the corporate side. Specifically, how corporate shareholders legally avoid tax through the Substantial Shareholding Exemption, or SSE. If a company sells shares in another company, the gain is automatically exempt from tax, assuming SSE applies. The fundamental criteria you need to memorize for the post-April 2017 rules are straightforward but strict. The selling company has to hold at least 10% of the ordinary share capital for 12 continuous months, and that needs to happen within a generous 6-year look-back window prior to the disposal. And please remember this crucial distinction. Only the investee company actually needs to be a trading company. The selling company itself, it no longer needs to be trading. So as we wrap up today's masterclass, I want you to continually ask yourself this one interconnected question. If you enthusiastically claim gift relief today to defer a gain, how might that inadvertently destroy your eligibility for BADR tomorrow? Tax exams aren't just about regurgitating rules in a vacuum. They are all about understanding the domino effect of the advice you give. Go over these notes, master these timelines, and I am absolutely confident you'll crush your 2025 exams.
Keep studying, stay focused, and I'll catch you in the next explainer.